This morning, you probably checked your bank account on your phone. You saw a number, maybe $2,000, maybe $20,000. You believe that's your money sitting in the bank. But here's what nobody told you. That money doesn't actually exist. It's not sitting in a vault with your name on it. It's not backed by gold, silver, or anything physical. It's just numbers in a computer database that can be changed, created, or deleted with a few keystrokes. And understanding this is the key to understanding why everything costs more while your paycheck buys less. Let me show you exactly how money works in the modern world, what changed to create this system, and why your financial reality is completely different from your grandparents' generation. Because once you see how the system actually operates, you'll understand why a house that cost $15,000 in 1970 now costs $450,000, even though it's the same building. Before we reveal the mechanics of modern money, make sure you're subscribed and notifications are on. This information fundamentally changes how you think about earning, saving, and building wealth. You'll want to remember this. Here's the transaction that happens every day without you realizing what's actually occurring. You order coffee through an app. $6 leaves your account. The coffee shop receives $6, but no physical money moved. Your bank didn't hand over $6 in cash. Instead, your bank sent an electronic message to the coffee shop's bank saying, "Reduce this account by 6, increase that account by 6. Numbers changed in two databases. That's it. The $6 exists only as digital entries representing nothing physical. Now travel back 150 years to 1875. Same transaction, completely different reality. You walk into a coffee house and order coffee. You reach into your pocket and pull out a silver coin weighing exactly 0.77 ounces of pure silver. You hand it to the merchant. He verifies it's real silver, checks the weight, and accepts it. You've paid with actual physical metal that has intrinsic value. If the government collapsed tomorrow, that silver coin would still be worth something because silver conducts electricity, makes jewelry, and has industrial uses. The transaction involved physical transfer of valuable metal from your hand to his. These two transactions, separated by 150 years, reveal the fundamental transformation that most people don't understand. The old system was based on tangible value, gold, silver, physical goods. The modern system is based on debt, trust, and numbers in computers. And this difference explains almost everything about your financial struggles today. For most of human history, money was commodity money. A gold coin was valuable because it was gold. A silver coin was valuable because it was silver. Even if the government issuing the coin collapsed, the metal retained value. This is completely different from today, where a dollar bill is valuable only because the government declares it legal tender and people trust that declaration. Remove the trust and paper currency becomes worthless paper. In ancient Rome, soldiers were paid in silver denarii. Each coin contained about 3.9 grams of pure silver. That silver had real value. You could melt it down, make jewelry, or trade it with anyone who valued silver. The Roman government could reduce silver content in coins, which they did, but they couldn't create value from nothing. They had to mine silver, mint coins, and distribute them. Money creation was limited by how much precious metal you could extract from the ground. This system persisted for thousands of years with variations. Medieval Europe used gold and silver coins. Chinese dynasties used bronze, silver, and gold. The Islamic world used gold dinars and silver dirhams. The principle was always the same. Real money had to be backed by something of tangible value. This created natural constraints on economic expansion and relatively stable prices over long periods. Then came 1971, the year that everything changed. On August 15, 1971, President Richard Nixon announced the United States would suspend gold convertibility. Before 1971, the dollar was pegged to gold at $35 per ounce. Foreign governments could exchange dollars for physical gold from U.S. reserves.
This system, established at Bretton Woods in 1944, made the dollar the world's reserve currency while maintaining a link to gold. But by 1971, the U.S. had printed so many dollars to finance the Vietnam War and domestic programs that it couldn't honor redemption requests. U.S. gold reserves had fallen from 20,000 tons in 1945 to 8,000 tons. France was famously sending warships to New York to retrieve gold, converting dollars as fast as possible. Nixon had no choice. He closed the gold window. That temporary suspension became permanent. The gold standard died, and the modern monetary system was born. What emerged was fiat currency. Fiat means let it be done. Fiat currency is money that has value because the government declares it has value. A dollar bill is worth $1 because it says this note is legal tender for all debts, public and private. That's it. No gold backing, no silver backing, just government decree and collective belief. This fundamentally changed how money works because it removed all constraints on money creation. Under the gold standard, if the government wanted to create $1 million, it needed $1 million worth of gold. Under fiat currency, if the government wants to create $1 million, it types numbers into a computer. Money is now created by decree, backed by nothing except trust in the government's ability to tax and enforce its currency. But here's where it gets even more radical. Most money today isn't even created by the government. It's created by private banks through lending. This process is called fractional reserve banking, and once you understand it, you'll see why the economy seems designed to trap you in debt.
And here's the part that will fundamentally change how you think about loans, mortgages, and your financial future. Here's how money is actually created in the modern system. You deposit $1,000 in your checking account. The bank doesn't store your $1,000 in a vault. Instead, the bank keeps perhaps $100 as reserves and loans out $900 to someone else. That borrower now has $900 in their account, but you still have $1,000 in your account showing as available funds. The money supply just expanded. Your $1,000 became $1,900 in the system. This process repeats. The borrower spends the $900, which gets deposited in another bank. That bank keeps $90 as reserves and loans out $810. Now there's $1,000 in the first account, $900 in the second account, and $810 in the third account. Total money in the system is $2,710 created from your original $1,000 deposit. This is how approximately 97% of money is created in the modern economy, not by governments printing currency, but by banks creating deposits through loans. When you get a mortgage for $300,000, the bank doesn't hand you $300,000 in cash from a vault. The bank creates a new deposit in the seller's account by typing numbers into a computer. The $300,000 didn't exist before you took the loan. The bank created it out of nothing, and you now owe the bank $300,000 plus interest. Your future labor backs that created money. You'll work for decades to repay money that was created digitally in seconds. This system has profound implications that affect your daily financial reality. First, the money supply can expand infinitely as long as banks keep lending. There's no physical constraints like gold reserves limiting money creation. Second, the entire money supply is debt. For every dollar that exists, someone owes that dollar plus interest to a bank. And third, if everyone tried to pay off all debt simultaneously, the money supply would collapse because money is created through lending and destroyed through repayment. This is why the modern economy requires perpetual growth. If lending stops, the money supply contracts. If the money supply contracts, spending decreases. If spending decreases, businesses fail, people lose jobs, and the economy crashes. The system is designed to expand continuously. Stagnation is crisis.
This is completely different from the old economy, where money already existed as physical metal, and loans simply transferred existing money from lenders to borrowers. Now here's why this matters for your financial future and why you can't build wealth the same way your grandparents did. In the old economy, based on gold and silver, saving money made sense because money held value over time. In 1300, wheat in England cost about 5 shillings per quarter. In 1700, 400 years later, wheat cost about 6 shillings. Prices were relatively stable over centuries because the money supply grew slowly, constrained by precious metal availability. Compare that to today. From 1913, when the Federal Reserve was created, to 2024, the US dollar has lost 97% of its purchasing power. A dollar in 1913 could buy what $31 buys today. This didn't happen because we ran out of goods. This happened because the nature of money changed fundamentally. When money can be created infinitely through bank lending and government decree, it inevitably loses value over time. This creates a system where saving in currency is a losing strategy. Your dollars lose 3 to 7% of purchasing power annually to inflation. Over 30 years, dollars lose approximately 60% of value. Your grandparents could save money in a bank account and preserve wealth. You cannot. You must invest in assets that appreciate with inflation, or you'll get poorer despite saving. The system punishes savers and rewards borrowers who understand how money is created. Here's the brutal reality that explains why housing is unaffordable. In 1970, the median house price was $23,400 and median household income was $9,870. A house cost 2.4 times annual income. In 2024, median house price is $417,000 and median household income is $75,000. A house costs 5.6 times annual income. Why? Because when banks can create unlimited credit, that credit bids up asset prices. More people can borrow more money, so sellers raise prices knowing buyers can access credit. Easy money inflates assets, while wages grow slowly because wage growth is limited by productivity and competition. The modern economy is designed to benefit those who own assets and understand how money is created, and to exploit those who only sell labor and save in currency. If you own stocks and real estate, you benefit when central banks print money because asset prices inflate. If you only earn wages and save in dollars, you lose because your purchasing power declines. This is called the Cantillon effect, named after economist Richard Cantillon, who observed that new money benefits those who receive it first. When the Federal Reserve prints money, that money enters the economy through banks and large corporations first. These entities buy assets, driving up prices. By the time printed money reaches regular workers through wages, asset prices have already risen. You get dollars that are worth less. Asset owners got those same dollars when they still had full value and used them to buy real assets. This explains why wealth inequality has exploded since 1971. The system is working exactly as designed. So, what does this mean for you? First, understand that saving in currency is losing money slowly. You must invest in productive assets like stocks, real estate, or commodities that retain value over time. Second, recognize that debt is a tool that benefits borrowers in an inflationary system. If you borrow $300,000 at a fixed rate and inflation runs 5% annually, the real burden of that debt decreases 5% annually. Third, develop skills and acquire knowledge that have value regardless of the monetary system. If fiat currency fails, practical abilities remain valuable. The modern economy operates on completely different principles than the economy of 100 years ago. Understanding these principles doesn't just explain why prices rise and wages stagnate. It explains the fundamental structure of the financial system and how to navigate it successfully instead of being exploited by it. Money isn't what you think it is. It's not stored value. It's not backed by gold. It's debt created by banks, controlled by central banks, and designed to lose value over time. This system has existed only since 1971. That's 54 years in a world where gold-backed money worked for thousands of years. Understanding how money actually works gives you the power to make decisions that build wealth instead of slowly destroying it. If this explanation changed how you think about money, hit that like button right now. Subscribe and turn on notifications because I'll continue breaking down financial systems they don't teach in schools. And here's important: watch another video on this channel about building wealth in this system. The more you understand, the better decisions you make. What surprised you most about how money actually works? Drop your thoughts in comments below. Let's discuss this, because understanding the system is the first step to using it to your advantage instead of being used by it. Thanks for watching.